Welcome to the Dividend Talk podcast, episode 175. Four stocks we consider to buy for Christmas. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co host, European DGI. If you want to learn more about us, please visit EuropeanDGI.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. How are you, my friend?
I'm doing really well. We're really well because it's December. We're really coming to the end of this year and we're at episode 175 already, Before you know it, we're talking about 200 episodes, which is a number like beyond my imagination. Who would have ever thought that we would reach even 175? So kudos to you also for the dedication, for sticking with me, Derek. I appreciate it really, really a lot.
It's a passion of ours. It's something we enjoy doing. I know we have busy lifestyle and we try to work around it, but we try and never miss a week. So it's something I always look forward to. But yeah, 200 was going to be awesome. I can't wait. Hey, we should try and make that a live show maybe. But let's get there
That's
first.
still half a year from now,
Yeah,
but
let's get there
look,
first.
if you think about as well, our community as well on Facebook, right? We also passed the 2,500 members. And it's really active lately. Just yesterday, for instance, there were 8 or 9 new posts, and people are talking about whether it's BuzzF or Games Workshop, right? There's a lot of interesting news being shared, dividend hikes. So if you're a European dividend investor, I would definitely recommend to join us on the Dividend Talk Facebook group. We'll put the link in the notes, but also shout out to all those 2,500 members, because we can see in the statistics that 80% of them are regularly engaged. Yeah, that's really high for a Facebook community. That's really, really high. So yeah, it's really, I really love it because it shows that one of our missions is really to make investing easier for Europeans. And also, we also have dreams for financial freedom, passive income. And while we have a lot of barriers with dividend tax or, currency impact, as a community, we stand so much stronger. And it's nice that we have this community. So I'm really proud on that.
Yeah, Europe is quite a big place, isn't it? So if you're trying to stay on top of every region, you have the Nordic region, you have Central, you have Western, East Europe. It's hard. So it's good to have so many different backgrounds and cultures sharing news from their regions. And look, it helps us stay on top of things. But I'm not surprised it has been so active this week because there's been a lot. There's been a lot of dividend hikes, big dividend hikes. There's a lot of news, a lot of things happening. So what stuck out in your mind this week?
Well, first of all, I think we have to talk, of course, about British American Tobacco, because the share price dropped by, what was it, 8% or something like that.
Yeah.
And we got also a question here from El Cuba on I believe on Facebook or Twitter, but also Luis Gerardo. Look, they had a 25 billion write down. Yeah, so effectively what they did is most of their balance sheet, I think 95% is on the asset side, right? So what they own is in intangibles. And intangibles here are just, let's say, the brand rights that they, like what Coca-Cola does as well, right? Those brands have a value because in this case, people smoke and how you say it, they put this in the books. The issue here now is that, they did kind of a strategic update and said like, hey guys, we're not going to push so much anymore on the traditional cigarette, because we believe in a more smokeless society, right? As part of their vision of building a better tomorrow. So also, so what they have done in return, they say like, hey, we're going more for the smokeless products. We'll push them more. They have not been profitable until this year, so now they are turning it into a profit. But having changed their strategy and also ramping up that non-smoking, let's say, or smokeless kind of products, the new products, new product categories, it means just that they came to the conclusions we need to start writing down on our intangibles here because they don't hold the same value anymore. I find it really interesting. I mean, this has no cash impact, right? The free cash flow is still the same. What I do expect, of course, with this is that the free cash flow will not be the same as per their predictions they had earlier over the next 20 or 30 years. But they expect the new categories to replace that. It's almost like a pharma company where the blockbusters will stop and you will need to find the new blockbusters, right? That's kind of how I see this. So I think it's good that the company is proactive with this, that they don't wait for too long, because then I would say you're just fooling investors. I also have a feeling that if British American Tobacco did this now, I'm curious if Philip Morris and Altria will also come with this over the next 1 or 2 years. At least it has paved the way for them.
Yeah, it's. I mean, management. You're right. Management are doing the right thing here. They're trying to get out ahead of the curve. If it came out and they were forced to do this, it would probably look worse. And 8% might have been 16%.
Yeah.
I think the real worry here is that the balance sheet is not the strongest, I would say.
Mhm.
I would actually go and say it's probably a pretty weak balance sheet. So when you see something like this having an accounting effect, it can, it can put fear into investors. So I can understand. I can understand the reaction to that. But personally, I still think the dividend is safe. I think they nearly went so far as to say that without saying that. I think they said something like it's not going to impact them.
Yeah.
So I'm quite happy with that. Look, a lot depends, as you said, on this new categories. What happens with that? Who knows? We know British American Tobacco are kind of, I would say, one of the leaders probably in that space.
Yeah.
But we don't know what regulation, what rules, what risks are going to come from that. So it's
Yeah.
for me, British American Tobacco is nice to have a small portion in your portfolio, but it should never be a main part.
No, I think either. It's a sin stock, of course, but their free cash flow, they're paying only half out in dividends
Yeah,
of their free cash flow.
yeah,
So from that point of view, the company is pretty healthy, and also, they have an interest coverage ratio of 6, which is also really good. So from a debt management, I don't see an issue.
yeah,
I don't see their free cash flow suddenly collapsing either. I do know that they have, I said that they predict a little bit less revenue growth than earlier. But if you look at the adjustments, I mean, the dividend is 50%. So you get like an almost 10% dividend now. But this also means if the dividend is like half of the payout ratio, that you get kind of a free cash flow yield of almost 20%. Then that's a 5-6 multiple. Come
yeah,
on, guys. This is simply unreal. Like, in my opinion, a healthy company should be at a 15 multiple during this market, and the stock, it should be at between 10 and 12. We're talking still half of this. Now, either I'm just totally blind, that I don't see something here, or there's something else. And of course, we have ESG investing, right? So I can imagine, well, I believe they even score pretty well in ESG. Because you have also their governance in there, right? But it's almost insane. This is just a cash flow machine, unbelievable.
yeah,
And if you compare to Altria, for me, some of the metrics look much better at British American Tobacco.
yeah, yeah. But then we have to realize the market it's in. It's a negative market, I would say, in terms of people's perception of it. So you can understand why the multiples are probably higher than what should be, and why their share price is depressed. So it's a tough one. Since stocks, I don't know, do we have a question on that today? But since stocks are getting hammered quite a lot lately, and it's hard in this type of market to put your weight behind them, because you want to focus on quality. We speak about
Yeah.
quality, and yes, I think these are a good company, but I definitely would not be calling them a quality company. They don't make that benchmark. So,
Yeah.
but if I didn't own any British American tobacco, honestly, with this drop, I would definitely be buying them. In my opinion,
Yeah.
I would, but I already own
Yeah.
enough in my portfolio.
And I have a deal with my wife to not buy them.
Do
So
you want me to buy some in my portfolio if you?
it ends up being the same then.
Yeah, of
But
course.
there's also why Luis Gerardo asks us, right? He says like tobacco and then
Ah,
alcohol,
yes.
Diageo and chocolate for Hershey are going to hell, and the world economy is cooling. Should this be a good opportunity to add actually some of those little sinner stocks?
Like we hear this phrase, don't we? Buy when there's blood on the streets, and honestly, very few people do that because it's hard. Because when there's blood on
Yeah.
the streets, you'll find a reason not to buy them. But look, I don't think any of those companies that you mentioned, British American Tobacco, Altria, Diageo, even Hershey's Chocolate, I think they're all going to be around in the next 10 years, in my opinion. And any dips and any corrections in these is a good opportunity to buy them.
Exactly. That's how I also look at it.
What else was in the news this week? Oh, we have a European version of JEPI, ticker JEPI, and look, this is causing a lot of excitement for European investors. You wrote an article about it already. Um, what's your thoughts? It's funny when I seen the actual ticker for Europe, I thought JPEG, the pictures.
Yeah.
But it's quite
So
exciting.
yeah, what really the good thing about it is here is that finally Europe is being taken serious. Yeah, also by a company of GP Morgan Asset Management. So what this ETF is about effectively is they invest in, let's say, 100 or something like that defensive stocks. What means defensive here? Low volatility. So the typical blue chip stocks like Johnson and such, right? But in this case, it's a global index. Yeah. So you will also see Japanese stock there, or European stock like Roche is in there. While JEPI is only focused on US stocks. What it does then, it sells on the MSCI World Index. It writes call options there. So what's effectively doing, it's using this index to generate income via call option writing, and this is how this ETF is kind of promising or targeting a 7 to 9% yield. I don't call the dividend,
Yeah.
as such, because in the end it's option income that you're getting mostly, plus some dividend income from the holdings in there, and they pay it out on a monthly basis. Now, this has become really, really popular in the States because it's of course a high yield income vehicle, and the expense ratio is 0.35, which is relatively low for an actively managed fund, right? Because
Yeah.
if you're doing option trading, you need to be on top of it. So my thoughts are simple, right? If you really want this, yeah, it could be nice, but capital appreciation, for instance, when you benchmark JEPI, because we can benchmark that with the S&P 500, it's really lagging. Yeah, over the last 3 years since its existence, it's kind of flat, while the S&P 500 clearly grew. This year, also the S&P 500 on a total return, so including the dividends or income reinvested, has been almost twice outperforming JEPI. Last but not least, the only good thing is over the last 3 years, the total return is pretty similar, where S&P 500 does better by 0.5%.
Yeah.
So all I'm trying to say is like, this is probably over time and losing money when it comes to capital gains, yeah, to your capital that you put into it. So if you put 10,000 euro into it, I don't expect in 5 years it to be 10,000 euros, but maybe 8 or 9,000 euro. So you really need to have it from the income, yeah, here, and then reinvesting that income. So for me, this is a vehicle maybe good when you're retired, but you just want to boost short term your income. But for me, I don't really see it as a vehicle as in my dividend growth portfolio. I mentioned maybe to spice it up because I've got kind of this really 1-2% of my portfolio where I can do some tropical stuff, let's call it like that. But for me, I wanna see. That's why I like investing in stocks, because if you invest in quality businesses, and I've seen it in my portfolio, then you get a dividend, plus you get growth, yeah, earnings growth that follows, where the dividend will follow then. and you've got just way more upside potential. And what happens here if the stock market corrects to the upside, jeopardy cannot really follow, because then all the call options will be triggered, or at least they need to roll them over, and then you lose, or you don't lose money, but it's capped. That's why they take also low volatile stocks, so that it doesn't hit them really.
Yeah.
But it means just like you don't really have growth potential here, and that's for me the big bummer with such an ETF.
Yeah, it's an income play. That's pure and simple.
Yeah.
It's not much
Yeah.
more than that, and you can see it trades within a certain range,
Yeah.
and you want to be buying it at the bottom of that range if
Yeah.
your plan is to make income off that. So,
But then you could also buy a bond now with 6% yield, or you could buy Cibus, a monthly dividend stock from Sweden. Yeah, it gets taxed at 30%. That's maybe the main difference, but you also get that almost at a 10% yield.
Yeah. But
And if you don't care about the capital appreciation, you could buy British American tobacco at only almost at 10%.
Of course, yeah, exactly. So, look, there's options out there, but for me, it's not even about the name of the ETF or what the ETF is. It's the fact that we're starting to see that coming into the European market now. So
yes, exactly.
And I just wonder, is there, because obviously this is owned by JP Morgan, but I'm wondering if the likes of Charles Schwab and Vanguard, are they sitting back watching and say, okay, let's see how successful this is. Do they make enough money from this? And if it is, we might start to see, maybe we might see the Charles Schwab one come into the market. And that's the one I think dividend investors we want to have. And ultimately, it could change a lot of people's strategies as well about how they invest their money.
Yeah, true. Well, hey, guys, if you're listening and you wanna own it, it's ticker symbol GEPG is the USD version. Then you have GEGP, so the GMP switched around. You will have the British pound version of it, and GGPI will be the euro version. I'll put the link to my blog post in the description of this podcast so that you can find it out. Unfortunately, the brokers that I'm using, as example, Interactive Brokers, we can't buy them yet. There's a notification there that the key investor information document is not there, but I checked it. It is on the website of JP Morgan. So, I mean, the ETF was launched just last Thursday. So let's give the brokers a few days of time to all get this together so that people can actually start buying it.
I wonder if it'll open up at that same loophole. Remember, Interactive Brokers, people could buy ETFs for a couple of weeks.
Yeah. I remember that. Yeah.
Okay. There was loads of news this week, but I think we'll try and move on a little bit because there's actually some big dividend hikes. We've seen a lot this year, haven't we, of big dividend hikes, and again we're looking above 10%. So Mastercard had a massive 15.8% dividend hike and announced an 11 billion share buyback scheme. I mean,
that's crazy. That's really crazy.
We talk about Visa a lot, but we always seem to neglect Mastercard. It's like their little sister or little brother sitting there. But again, 16%. It's mind-blowing, isn't it?
And Broadcom as well, 14%. Yeah, Broadcom. I don't like it because I don't like this business. That's how I should say it. I mean, it has been giving stellar returns to shareholders. But I always shy away from this company because this CEO is a nut job and he's a leech. He acquires companies and sucks them totally empty, right? But with that, he's probably doing the right thing. But every time when I read it, I feel like, yeah, this can't be sustainable. But the issue is, I've been thinking this for 7 or 8 years. So this is a company I clearly misassessed here and missed out on.
I don't know if you remember one of our very first episodes, the guy from South Africa, Dividend John.
Yeah.
I haven't heard from him in a long time, but he was constantly, even before the podcast, after the podcast, he was honest. Broadcom. And I'm just going back to look at the share price at that point, and it was trading in and around 200 USD, and it's upwards now, 940, nearly 1,000.
Hallelujah.
And they've been growing the dividend quite impressively in that time as well. So yeah, we've missed a trick on this one, I have to say. But again, you can't borrow conviction. We always say that, and if we don't
Yeah.
have enough conviction, right or
I don't
wrong,
have conviction for Broadcom. I'm sorry. Yeah.
yeah,
I
right or
have it
wrong,
with Texas Instruments, yeah, but not with Broadcom. And
yeah,
clearly a misjudgment so far.
yeah. Well, just look at their dividend increases. What are we looking at?
Yeah.
2018,
No, please, please, please.
51%. 2019, 22%. 2020, only 10%. Come on, guys, what's going on? 2021, 13, 12, and 14%. Come on, like it's crazy how they're doing this.
Yeah. Yeah. Okay. Let's move on.
Yes.
Ali Lilly also hiked dividend by 15%. So ticker symbol LLI,
Yeah.
LLY. And then really surprising to me, CVS Health announced a 10% dividend hike. That one really caught me by surprise because this company has been struggling, similar with Walgreens, right?
Yeah.
And then they are able to spit out a 10% dividend hike. That's amazing.
Yeah. I mean, I haven't looked at them in a long time, but I do know there's always a debate in Walgreens and CVS, and they kind of in the market that they're in, they kind of own both halves,
Yeah.
so to speak. They own a half each, and from the outside, it seems CVS is definitely better managed. But look, there's a lot more turmoil in Walgreens. They changed the CEO as well. So, but yeah, I'm shocked. I'm shocked at that, considering that they were struggling so much at the start of the year. To turn out a huge 10% hike like that is something I didn't see coming. But
No, me neither.
Bristol Myers Squibb, you must be happy about this one. 5.3% dividend hike.
Yes, because I just bought a few of those to wrap up my position. Let's say it's now full position size.
Yeah.
So, it's the weakest in the queue. But, Bristol Myers is generally being challenged, of course, a bit in the portfolio. It's still like low payout ratio, heavily big free cash flow. We'll see how that plays out into the future. So I just see conservative management here. I rather have that than now, committing too much dividend hikes and then being later in trouble. So I think they're managing well.
Yeah.
Yeah.
And
The
finally,
last one, Deere and Company tractors. Who would have thought, right? 9% dividend hike again. Ticker symbol DE.
yeah, and of course we mentioned them on the show here a couple of weeks ago. And quality company, I think we spoke about this in the farming world. Everybody wants to own Deere and Company equipment, and look, 9% dividend hike is quite good from these guys. So good hikes all around. It's been an early Christmas present for some people, I have to say.
Unless you're a Fresenius investor. Have you seen that? Yeah, we could have also addressed it in news of the week, but Fresenius is borrowing 300 million, or they are getting 300 million from a kind of a fund for hospital relief to compensate for the energy prices in the hospitals. They're taking it, and with this, they cannot pay out bonuses and they cannot pay a dividend. So they are therefore suspending it. Interesting fun fact: they are considering going to court to fight the the ruling that they can't pay bonuses. Not dividends, right? They don't care about the shareholders, but they want their bonus. So that's very interesting, right?
Yeah, and look, it shows you the mindset of management there, really, doesn't it?
Exactly, and that's why I wasn't surprised that Fresenius would come into issues with the dividend, because we saw that kind of coming. Of course, we didn't see this coming in particular, but we knew this company is struggling, poor management execution over the last 2-3 years. So and then they want to go to court, or for getting a bonus, that this shouldn't be part of the rules to get this monetary relief. For me, it's insane. I mean, yeah, it's insane.
Yeah, I mean, I was shocked that it's been cancelled pretty much. I expected a cut. I expected the dividend to be cut, and probably a heavy cut, 50-60%. I was not expecting it to be completely suspended.
Yeah,
I think that's where the shock is. But I did not know that about management. It's to me, if I was a Fresenius shareholder right now, I would be more furious over that than them actually suspending the dividend.
Yeah, and then and the fact that they need 300 million. Yeah, and because if it would have been a bit better managed, they would have had this money on the shelf and
Yeah,
be able to pay it and not make the shareholder the victim.
yeah,
Maybe if you're a shareholder and you still believe in the company and management quality, just know that they mentioned that then the year after they want to continue their dividend policy again of paying growing dividends. So it is kind of what we saw with some insurance companies like Nationale Nederlanden at the time, right? They all had to stop their dividend due to governmental pressure during COVID.
yeah,
So Fresenius is in a similar situation right now. They're not hit by a virus here then, but they're hit by energy costs as a result of the war with Ukraine and everything.
yeah,
But
yeah. And
yeah,
yeah, they are in the middle of a transformation, aren't they? Like it's a complicated business as it is, and
yeah,
they're trying to simplify it and simplify what different aspects they own. So they're in the middle of that. So if you believe that they can come out and with their new structure and become profitable again and grow the dividends, I would still caution. I still think there's time. We've said that about lots of different stocks. You can
yeah.
wait on this for 12, 18 months, and I don't think the share price will be too
Yeah,
far from
but
where it is
come
now.
on, they are asking 300 million.
Yeah,
Yeah, they have a free cash flow of typically around 2.5 billion. Yeah, they have about a 50% payout ratio on that. They could have easily funded this themselves. So I also feel, because that's what I read between the lines, and that's maybe also why they are going to court. I feel that they are put with the back against the walls, that the government is putting pressure or something like, thou shall use these funds.
yeah.
Yeah. That's my suspicion, but they're not calling it out loud in their release. Yeah, so it's kind of like, okay, I'll take the money, but I don't want to take the money. Yeah,
Yeah.
and they don't need the money. They just don't need the money.
Show me the money.
Yeah,
And then finally, WP Carey cut its dividend by 19%. They didn't call it a dividend cut. I can't remember what it was. It was like they were restructuring. It's like a stealth dividend cut, isn't it?
yeah, yeah. So we know now what it is. A reset, 20% reset, and 25 years of dividend growth down the drain.
Yeah, yeah. And that was funny because I think we put the rating as questionable, and a week later they cut the dividend. So
Yeah, exactly.
okay, so our main topic, it's getting into Christmas season. We're in December. So we're going to talk about 4 stocks that we will consider buying this month in for Christmas. 2 stocks each. What's the first one on your list?
So the one that I really would love to have under the Christmas tree is actually Agree Realty.
Hmm.
So for me, Agree Realty, I bought quite some real estate investment trust over the summer, like August, September, and then I thought, okay, it's getting a bit much. But the more I study this business, the more I like it. So for me, the Agree Realty is like when you're the oldest guy, right, in the family, and suddenly you get 8 years after your little sister is born. It's a baby, but then at a certain moment it's a teenager, and it's just hot as hell. And you know this because all your friends are starting to look different when they come home. Oh, has this became of the little sister? This is Agree Realty for me. Yeah, it's just like, let's say barely 18. Yeah, as such. And that's how I look at it, because realty income was here probably at this stage like 15 years ago, something like that. So it's still small enough, this company, to grow. And it has a similar portfolio. So Walmart is 6% of their tenants. They have Tractor Supply, Dollar General, Best Buy, CVS that we just mentioned about, TGX, Dollar Tree. Yeah, these are their main tenants. Yeah, and so well diversified, 10% in grocery stores, 8.6% in home improvement, tire and auto service, convenience stores, 8%. So in other words, really well diversified, defensive tenants or with defensive profile. This is just Realty Income's pretty younger sister, in my opinion. It still offers a 5% dividend. It has been compounding the dividends over the last 10 years by almost 6%. And the nice thing is here, you also get the typical, how is it, capital appreciation with this one still. So unlike realty income, which is kind of starting to diversify, right? Because they cannot buy anymore like a few shops for Walmart and rent them to. They now need to do multi-billion deals, right? But if you then look at the cap rates, they're quite questionable. Yeah, so for realty income, I still feel it's like a very strong stock, but I rate Agree Realty with the growth prospects and their safety profile higher at the moment than realty income. So for me, I'm really looking more at Agree Realty. Also, the share prices after the initial growth of the last few weeks are coming a little bit, stabilizing a little bit, and for me, they are still attractively valued here. Of course, biggest risk of Agree Realty is interest rates higher for longer, but I believe over the next few years they have hardly any debt payments. They did really well. They used the lower interest rate environment to reissue debt all into the future. So this company is so well positioned. For me, it's one of the best real investment trusts in the market out there. And although I really started to study it this year and it was a tier 4 position, I'm bumping it up to tier 3, which means I can allocate more capital to it. I usually don't do this, but it shows just quality everywhere. And for me, it's I'm not, I said, I'm not the biggest fan of real estate investment trusts, yeah, because of its long track record of dividend cuts as well. They are not, you don't really have dividend kings like that, yeah, compared to the consumer staples. But Agree Realty, I still see there easily 10 years of sustainable growth there.
Yeah, yeah. Hey, that's high praise for them to be the best real estate investment trust out there.
Maybe not the very, very best. There are some of those apartment REITs, I would say, but they offer really low yield in return. So they don't have this. So they have this. They have probably even a bit less risk. Yeah, if you're now in the Sun Belt there in Florida, but the rewards are also much more less. So let's call it, for me, one of the best risk rewards in the real estate investment trust.
It makes sense. Yeah, and looking at their tenants, all real strong tenants. You'd have no real concerns really. Like it's as you said, it's like looking at a miniature realty income to be fair. So it's yeah, good option. Good option. It's actually one I overlook quite a bit when it comes to REITs. I think I always gravitate towards realty income when I'm looking at these specific ones. So
so give it some study. Give it a chance.
You've piqued my interest, I have to say.
So maybe in 2 or 3 weeks from now, you should do a deep dive in our premium newsletter on this one. How about that?
That's not a bad idea. It's not a bad idea.
Good.
Number one on my wish list is Siemens. I've spoke about these, I think, over the last few months. I really am kicking myself. I did not buy enough of these under 100. We spoke about it on the show. When they jumped under 100, it was time to load up the truck. I mean, it was an incredible time to buy them. I bought a couple of shares, but honestly, not quite enough. And actually, I did a stock card. So we have our stock cards as part of our premium service, and I did that on the 17th of November. And at the time, they were 140 euros. That's only about 2 weeks ago. They're now upwards of 160. So the last month, they've really just popped. And look, I'm not surprised. Where's the catalyst coming from? You know, I'm huge in automation, digitalization, intelligent infrastructure. It's my area of competence. It's what I work in. I see huge growth potential. I was looking to see what the growth rates are expected through the next 5-10 years, and it's expected to be 14.2% compounded through to 2032. So I mean, this market is booming. There's a lot of growth potential there. There's a lot of money to be made, I think, from particularly companies like Siemens that are involved in all aspects, from actually making the components that are needed for these to actually driving the digitalization itself. So I think they're involved in all aspects, which I really like. Of course, there are some risks with them, and the big one is with their legacy. I would say their legacy segments. So their digital industries is starting to decline, so they have to, and that does that. It's always, that's like the cyclical part of their business. So they have to try and destock, they have to try and reinvent and all that. And then you have China, which is a big part of that, which is also coming to a slowdown. So that's obviously the big risk with them. But honestly, I see so much growth in this industry over the next 10 years. Um, I think 160 is probably a fair price for them, to be fair. But honestly, I'm kicking myself. I didn't buy enough of these. But let's have a look at that financial overview. You're looking at revenue growth has been quite flat over the last 5 years. I expect that to start accelerating over the next 5 years. Their EPS growth has been 10%. They have a decent credit rating, and their cash flow, their payout ratio from their cash flow and earnings is only at around 40%. So there's loads and loads of room here for them to continue growing that dividend.
Yeah, for me, one of the best companies in Europe, and probably, well, almost the best company, I guess, in the industrial sector as well. I mean, and what is nice is that they've been positioning themselves over the last years really to double down on these growth trends.
Yeah.
And this is so unique because often we see these companies, they get used to the cash flow or something like that. But Siemens has really high quality management when you think about it, right? And we have done a whole show about this in the past in one of our earlier days. But it continues to be, yeah, really, really interesting, really interesting.
It's so funny you say that, because these trends, and they seem like there's something new because it's more mainstream. But within my industry, we're talking about this intelligent infrastructure. We're talking about digitalization for the last 10 years. It's not something new. Usually it was just buzzwords thrown around in meetings and people sitting around. But it seemed like Siemens, and looking at it now, going back the way, are probably one of a handful of companies that actually took it by the reins and started to drive it forward. And they had a bit of short-term pain with that. But I think, honestly, the rewards over the next 10 years, I think, will make up for any pain they had over the last few years.
Yeah, I think as well. Great pick. Okay, so I hope Santa Claus will be, nice for you. So for me, a company, the second company that I really wish to be on the Christmas tree, and I think it should be possible, is Iberdrola. It's a Spanish, Spanish utility company. They make about 50% in profits from the networks business. So what networks means is like transport of electricity, specifically through Spain. And the other 50% in, let's say, more like the production of energy. And a lot of that is in renewables, but they have also, I think, 2 or 3 nuclear power plants, as an example. And yeah, for me, this is a really nice company, and one that I did a deep dive on in the latest premium Dividend Growth Compass newsletter. But as an example, did you know that it supplies electricity to almost 100 million people in the world? So they're not just in Spain, right? Yeah, no, they're in Spain and the US and in Mexico. They're actually a global powerhouse, even in the United Kingdom. Yeah, so, and it's really, really impressive to me after studying it. So kudos also to our Spanish followers who have been bringing up this company from time to time. What is they're profitable, yeah, with renewables, and we have seen Shell dipping in their toes into renewables, and they are again winding this down to some extent because the CEO wants to maximize shareholder return. Yeah, so but here we have a company that's actually able to do that. So for me, this is very, very interesting. And they have now about 62,000 megawatt installed capacity. And this is just really, really large. And you need to know that 1 megawatt produces electricity for about 1,000 households, but at the same time. Yeah. At the same time. So, the company has been investing a lot. It invested almost 140 billion, I guess, over the last decade or something like that. And it's still aiming to invest 47 billion to the end of 2025. So it is really, really investing a lot for the future. And I'm not surprised because, look, Europe's Green Deal, yeah, how much money will come available for this? If you look at the targets, right? I think, what is it now? 15 to 20%, or maybe even 15% is like, let's say, green energy in many European companies or in Spain, and they want to get to 40 or 50%. Now, if Europe wants to get there, they need a lot of equipment for
Yeah.
this and a lot of production. And Iberdrola is just probably the best positioned company to deliver on this. So you can get it at the moment at a 4.5% yield. It's trading just below 12 euros per share. I think their dividend is definitely safe. They have a healthy payout ratio, and they're also committed to a growing dividend. At least that's how I see their behavior, let's say. So it's a really nice company. I would say the main risk is, and we saw this a bit in Mexico, because what in Mexico, they want to be more in control over their energy supply. So I don't kill me if I say it not 100% correct, but it came down to the fact that they said, like, okay, public companies, you cannot really grow anymore. We want our nationalized, privatized business to really take on the, how is it, building new capacity and such. So I believe Iberdrola is also fighting this in court. But I think this is one of the main risks, right? That countries will say, like, you know what, leave this to us. Yeah, because we've seen over the last 2 decades more this free economy, privatization of this energy market. But I can still see that specifically in some countries that are maybe less mature when it comes to capitalism, that they will be more having an urge to privatize this and be in full control. Even in Spain, right? Because people always talk about Enagas and how the government is dealing with this.
Yeah. I mean, look, there's always governmental risks with companies like this, and you can understand it in twofold. Like, the governments they probably want the piece of the pie, but you would like to think that they want to do right by their citizens as well, and they don't want costs getting out of control. And
Yeah.
you can see recently, with the start of the Ukraine crisis, for example, costs got out of control quite quickly, and
Yeah.
we were having talks about government stepped in, should they or should they not do that?
Yeah.
So maybe that probably sparked a few countries thinking we need to get ahead of this and get it under control more quickly. But you really sparked my interest in Iberdrola. I did not know that they were so heavily involved in the renewable transformation. It's something I wrote about, UK green wind. Something I'm quite bullish on, because Europe have this target, and we're so far off this target. I mean, it's not even funny.
Exactly.
It's so hard to get there. And look, wind and solar have their place, but hydrogen is going to be the real driving force, I think. And the fact that they are so heavy in this, and I did not realize that, it's honestly, your article, as I spoke to off air, it's really piqued my interest on this company, and yeah, great pick, and great article, by the way, I have to say.
I think
it's not an easy company to
no,
digest.
it was really difficult to analyze this one. It took me so much time. It's also really hard to value such a company and such here. But look, really simply said, I'm big in oil in the energy sector. So having this one, if and when I buy something this month, right, and then this UK green code UK wind will hedge my portfolio a little bit with the risk that we have with oil and gas, right, where it's more like low multiples at the moment. So it will hedge my portfolio a little bit. And either way, if oil goes down because renewables are better, it's kind of like probably hedging itself out.
Yeah, nice pick, I have to say, nice pick. The second one on my list, actually, look, it's not Christmas. Everybody knows Christmas starts when you hear the Coca-Cola Christmas ad on the TV, and that's my second pick is Coca-Cola. I think maybe 2 or 3 years ago, I was saying at the time to hold out investing in these guys. I thought that the share price wouldn't move. It hasn't. They were doing a lot of restructuring, which they had finished. Unfortunately for them, they went from finishing their restructuring, which took a heavy toll on them, going straight into COVID, into lockdowns, restrictions, which stunted them. And then we came out of that and we come into like a high inflation. So it's really been against Coca-Cola over the last, I would say, 4 or 5 years. But I think they are well managed. They've come out of that. They are really starting to digitize. I really like that they're moving into Costa Coffee. I don't know if you have Costa in Poland, the Netherlands, but it's pretty big over here.
Yes, quite a bit.
It's quite big over here. I didn't realize they had 14,000 stores at the minute and growing. So I think it's definitely a brand that they can target the likes of Starbucks with. And there's plenty of growth left in coffee. I think that's expected to grow around 5% per annum over the next 5 or 10 years as well. So look, Dividend King, I think the dividend is safe. They're committed to their dividend. But for me, yeah, I think it's a no-brainer. Look, you're not going to get much growth. It's a slow-growing company. You're not going to get the mega growth, maybe of some other companies. But I think as a steady all-rounder to having a portfolio, I think Coca-Cola is definitely becoming more interesting. I added some shares. I added 20 shares there a couple of weeks ago as well. But yeah, I think they're starting to become attractive and to look at them a little bit more.
Yeah, nice one. And I think also now, when you think about Costa Coffee, right, when they bought it several years ago, it was 5-6 years ago, people were so bullish on Coca-Cola, but then I did the analysis and it was hardly a blip on the radar. Yeah, so I'm curious to see how meaningful it is now contributing to revenue and profit.
Yeah, like that's what I'm saying. I was shocked it was 14,000 stores. I was trying to flick quickly to see if I could see that, but I couldn't see it too easily. But 100%, that's when I do a deep dive, that's one of the ones that will stick out in my mind. Because look, if it's only going to impact 1 or 2%, then it's not worth anything. It needs to have some sort of decent impact on them. But yeah, look, I think Coca-Cola has been under the radar, and it's just a steady dividend grower, and I think it's definitely should be in. And look, you think of Coca-Cola, what do you think of? Unhealthy drinks, but they're really trying hard to banish that now. So I don't know if you've noticed this, but there's definitely more adverts happening that I can see on TV, social media from these guys really pushing these. I'm not going to say healthy, but no calories, no sugar.
Yeah, exactly.
They're really drumming that up, and they're just trying to get it into your head that Coca-Cola is not unhealthy anymore. We do have better alternatives.
They have enough alternatives. Yeah, I'm only drinking cola zero sugar because since I stopped drinking sugar so much in general, I feel much more better. Yeah, so although I think in the end, it's just soda, right? With these kinds of things, don't drink too much. But I think it's good. It shows just that there's a future for Coca-Cola. Yeah, it's not a tobacco company.
Yeah, like they've been around for over 100 years, so they know how to pivot and transition and move with the trends. So I'd be comfortable having these as not a core stock, but like on the second, on top of your foundation, like a mini foundational stock.
Yeah. A bit. Good. Let's go to the listeners' questions. Yeah, I think it's about time. But really nice. I hope actually that you will get those from Santa Claus, right? That it fits also through the chimney. I've got a big chimney, so it should. And at least one of the two I expect. I'm really on the short term. Agree Realty should be an Iberdrola. I want it in my portfolio. I'm just not sure yet if it will be before Christmas or not. But I'm definitely considering it as what we also have this title of the show.
Yeah.
So we got a lot of listeners' questions. So let's see how quick we can go through these. The first one is from Runje Schoger. And he's saying like, hey, listen up. I'm getting the hang of firm level analysis, but he's still struggling with things like the cyclicality of certain sectors. And what books do we regard, we like regarding macroeconomics? So there are two books, Renje, that I would consider here. The first one is Howard Marks with Mastering the Market Cycle. And the second one, please don't make fun of me, but it's actually Jim Cramer with Get Rich Slowly, because I know he's a pundit and people always make fun of him, but he's not stupid. If you read his book, he has a really nice chapter in there about sector rotation. And that was very, very insightful for me at the time. And I see these patterns that he was describing. I see them often from time to time. Yeah. And that book I often go back to when I see this, and because he's writing about those sectors and the different sectors and how you can see the sector rotation. And it's very insightful. Yeah, I will put the two books in the description of this podcast.
Yeah, poor Kramer gets a lot of hate, doesn't he? But I mean, he's so in focus that everything he says is scrutinized. I mean, I'm sure we've said things and the opposite has happened, maybe straight away, but our reach is not as big as his, so it's not under as much scrutiny. So you have to feel sorry, but you don't get to his level of popularity or unpopularity without knowing something. So
Yeah.
yeah, I'd have
And
no.
then, I mean, yeah, he's an entertainer. He needs to fill in
Yeah, of
5 days a
course.
week a
Yeah,
show. And, he's been very often wrong. And there's, of course, the inverse Kramer ETF as well.
I love that.
Yeah. So, but, in the beginning, he inspired me a lot. I was often listening to the Jim Cramer, how is it, show via the podcast. And, he has CEOs on that he's interviewing. They're often very insightful. And he inspires a lot with that. Yeah. So
Interesting.
I don't take advice from Twitter and from the internet. Yeah.
Yeah,
But inspiration is something else. So if he's talking about companies, I hear CEO talking, I can go to the financial statements and check if it's indeed such a strong company or not. But that's what and he has been. I mean, think about how many people he has been. How is it inspiring to get to do investing, to do stock investing or ETF investing, who would have otherwise maybe not done it. And I think that's the best what he's offering.
yeah. Rayhan has asked us about investing in discovery pharma space. Obviously, the painting cliff is something that is continuously there. It's always a real threat. You can get lucky with AbbVie and manage, say, something like Humira well, but he's talking about Bristol Myers here that have two patents coming up. So he works in the space himself. He understands it's a bit of a lottery getting through the phase trials. So how do you look at it?
Yeah, so for me, you need to look at it more as a portfolio management. These. So I think to be a small, let's say, startup, biotech startup, to grow and become a blue chip is nearly impossible, because at the moment you get your science together and you're going to, let's say, be in phase 2 or something like that. You already need to start thinking about the drug supply, the manufacturing, all these kinds of things, proper clinical trials, and usually those scientists don't have it. Yeah. So we had Gilead as an example, that pulled it off, right, to become so big. But this is for most companies just nearly impossible, which is also an advantage to the big blue chip companies like AbbVie, because those small potential future billionaires, those scientists, they need a company that can do this for them, and that's where the deal making happens. And that's why you also see a lot of those companies investing in early stage companies,
Yeah.
because they want to, of course, buy the next blockbuster and even take the risk if needed. So also these companies work a lot with licensing deals, right, here. And so I think you need to evaluate companies like AbbVie more on their portfolio management, their track record, and understand the risk of a huge patent cliff. And this is where you need to think then again about diversification, the potential in there. But it makes pharma stocks in general really hard to invest in here, because you then start to depend on management, track record, and these kinds of things. And that makes it a bit harder. Nevertheless, some of these blue chip companies have done very well for multi decades.
Yeah, yeah. I mean, it is hard for the average investor, because we look at numbers and then we might look at catalysts, and to gauge a catalyst, you're probably reading what the CEO is writing or what the company is writing, and they're obviously going to be very bullish. But honestly, we don't understand enough about the pipeline, what it means, and we probably don't even understand how much of a lottery it is. Like as Rayhan said, it's he works in that industry. Getting one through that phase is probably one in a million. So I think pharma is probably one of those spaces that looks easy to analyze on the front end, but it's
Yeah.
actually quite a complex and difficult beast to
So that's why
understand.
I did a video earlier this year. People will find it when they go to my YouTube channel, because I didn't produce so many videos this year. So it's one of my lasts, I think, from there. Um, but that's why I look at the pipeline, look at the top 3 selling drugs. I see how much of their revenue is consumed by this, and then you kind of know what risk you have in the patent. Because I also looked at the big pharma, at when their patents are kind of getting to end of life, because you can't really say even expire, because often they make such a whole patent cluster. So that they generate many new stuff on top of it, so that they prolong, let's say, the life date of the drug and the protection of the drug. But that's one way of looking at it, right? It's really like a risk mitigation approach from that point of view.
Awesome. We have a question from Yoram. He's asking us about our thoughts in investing in the Singapore dividend stocks. I haven't looked too much into anywhere really past Europe or America. I think we get this quite a bit as about Chinese stocks, Hong Kong, Singapore, and even Japan. I think there's some quality companies there. But for me, it's outside my circle of competence. I prefer to stick with the US dollar and also the euro. And I have some UK stocks as well, which adds additional currency risk. But for me, that's where I want to stick. As I said, there's probably good companies that are here, but I don't know. He has mentioned that there's a 0% withholding tax. I don't know what way that works out. I still have to pay the same tax whether it's withholding or not. I'm still going to have to pay the tax to the Irish government. So that
Yeah.
it's not really an incentive to me. So I prefer sticking to US European stocks only.
Nice.
M Lawless has asked us, he's sure this has been asked before, what platforms we both use.
So I mean I can put a link to my blog post that's written about this, but it's Interactive Brokers, The Hero, and Trading 212. Trading 212 is really for me to play a little bit around with Pi. I have the Noble 30 Pi. I still have technically Saxo Bank, but almost nothing there. I moved at the time everything to Interactive Brokers because Saxo Bank has this monthly management fee that I just don't like. Too much for me, but I'm still doing a little bit of option trading there.
Yeah. For me, DeGuero and Interactive Brokers is what I have. Collect Dividends has asked us about Steven Bavaria's strategy and book called The Income Factory. Have you read it? No, I have it here. He talks about investing in kind of high yield CEFs. You're looking at your 8 to 10% range, and it's just it's not dividend growth. It's a dividend strategy, but it's more high income, and it works. He does it. He's been doing it for 10 years. I think there's merit to it. I think if you go back on some of my blog, like you, I don't write my blog much anymore, but I did incorporate some of this into a portion of my portfolio where I was buying these CEFs as a high income part. Unfortunately, I can't buy these companies anymore on the US. They don't have a key investor document. Interactive Brokers allow me to for a while and then they stopped. So I don't hold any of them. But I think there is definitely merit to this strategy. But I don't feel like you have to have all your eggs in one basket. You don't have to have like all dividend growth and then all high. So you can mix and match. So I think there's a place for it within a diversified portfolio. SB92. If you see a dividend get slashed or the safety of the dividend is in real jeopardy, what point do you sell out?
Well, a good example is 3M. Yeah, I don't think their dividend is safe, as an example, because of all the litigation. So I started selling it. I still have a few shares, but not a lot anymore. I know I've been selling it at a loss, but there are opportunity costs because at that time NN Group and ASR were really attractive. So I didn't really lose dividend income. I actually gained on dividend income with that, but I see more potential in ASR and NN Group, although NN Group has also litigation, of course. So it's like from one bucket to the other bucket, but ASR has already settled and they can easily consume that. I expect something similar for NN Group. Actually, the CEO was on the radio the other day, so I listened to that. And they are at least at the talking table again around the settlement, but I could sense some anger there because they settled already, let's say a decade ago, thinking that this wouldn't come back, and now it came back again, right? So in any case, that's how I usually look at it. I just start selling when I think the dividend isn't safe. And I don't sell everything if it's a big position all at once. I just do it in brackets because I might be wrong. I will not be in a hurry at that time, and I can do my proper due diligence.
Yeah. It's a tough one when you have a company, say like I have Walgreens, where I feel like the dividend is probably going to be in jeopardy. I don't know, but I'm still hanging on to them because I don't want to sell them at a huge 50% loss. And then if they cut the dividend, then I'll probably be forced to sell them and take the loss as well. But
but dividend cutters, they underperform. It's always better to sell before the dividend cuts, or statistically speaking, it's better.
Yeah, no, it's just, yeah, 100% right. So th- they seem committed to it. They do have like a long history in it, so I think they would be reluctant to cut the dividend. But if they did, I think it would be time to go. But honestly, I would not be surprised to see them cut them. But on the likes of Fresenius, I had owned them, but I could see a dividend cut coming, so I sold them even beforehand. So
Yeah,
I think it's case by case as well.
yeah,
I don't think there's a hard and fast rule that you just sell. So just take it
yeah.
case by case. Um, we got a question from Ark. That's us, I think. Ark. I'm just going to call you Ark. I guess I can't pronounce the rest of it. But they are saying there's an EU version tax efficient pension plan account like the OIPE. Are you going to use it?
I'm not aware of it
Yeah, I didn't
actually.
know. I
So
didn't
he
know. Yeah.
triggered my curiosity here, and Arek, what I will just do is I need to look up on it. If you have more information already, then a nice article or something like that, let me know. We can also share it maybe on the Facebook group. Generally, I'm not using my own. So in Poland, we have something like that as a, let's call it. Yeah, it's called IKE or IKZE. There are two vehicles there where you can invest tax free, let's say, but you can only get it at a certain age. I don't know if it's 60 or 65. Personally, I don't use it because I want to live on the dividends before. But my other half is we are maxing it there out. So we, in the end, because we are both married, of course, we do invest a bit there. But on my personal name, I'm not doing it because I want to live off the dividends earlier.
No. Yeah, no, like you, I haven't heard of this. It did actually, when he said it, I was like, oh, maybe I should know this. So maybe,
Yeah.
maybe you should
But what we are
heard about it.
seeing here is the further how you say it, the pension system in Europe is not sustainable,
No,
right?
no.
And what they're doing now is giving more power back to the people because I guess the government doesn't want to be in this position that everyone starts rioting later when they can't get any money. So they're following more and more the American model, and then also they're looking at harmonizing the dividend tax across Europe. So there are really some policies that are coming towards in favor of our investing style, right? We might actually be the early birds in Europe when it comes to this still, from a history point of view.
Yeah, yeah. Time will tell. UT has asked us, what was the last stock you bought that changed for the worse in a way that you should have seen before buying it?
And doesn't come so quickly to my mind, but there are always a few stocks that went down. I mean, I remember buying Alibaba. It's now at half the price. Could I've seen it come in at that? No, I couldn't,
I
because
don't
otherwise I would
think
have
so.
waited.
I don't think so
No.
with Alibaba. I don't think so with Alibaba because their fundamentals are strong.
Yeah, exactly. The fundamentals have actually been doing well and still growing. Massive buybacks now. Just the market appreciates it at a really low PE ratio at the moment. Yeah. So not really. I made my mistakes in the past, like Tupperware and such, but that's already so outdated. Nothing recently, I would say.
Yeah. Well, look, I've mentioned Walgreens previously. They will be there. Actually, I didn't realize how much disdain there was for Rite Aid over in the United States. And my sister was over. She's living in New York. She came over last weekend, and she was asking, "Oh, you still invest?" And I was telling her about Walgreens, and she was there. Oh, and then she proceeded to tell me how much Americans absolutely hate Rite Aid over there. Like it's like she said, it's ridiculous. And I was like, I didn't really
But what
know
is
that.
Rite Aid?
Rite Aid is part of I think they're like part of the pharmacy business over there. And I still don't understand why people hate them so much, but there must be some litigation or they must have been involved in some dodgy dealing. So it's
So you didn't ask your sister why, but rather say, "Oh, shut up."
well, if I asked her why, she'd probably not know too much and and just give
Oh,
me some.
come on! You should you should think better about your sister.
Well, she didn't.
She would know.
Maybe. She doesn't listen to this, so I can say what I want.
Okay, but you can call her up later and ask her,
Yeah,
"Hey, tell me more about Rite Aid,"
yeah,
because my buddy on the podcast is interested.
yeah. I'll tell her to call you.
Oh, good. Anytime.
Javier has asked us, how do you use put and call options in your strategy?
So I use it really a little, right? But just enough to gain some additional income. So I write put options on stocks that I would like to own at the price I would like to own them, and call options only on one or two stocks. So for instance, on ExxonMobil, I'm typically writing call options above 110, because if they get called away, that's okay. It's a company that I don't find the strongest company in my portfolio. So call options I hardly ever write, but put options is let's say 80% of my strategy when I do option trading. But still, again, I don't have a time really to do a lot of option trading. So yeah.
We'll move on to some stock related questions, and we have one from Mayak who's asking us, when is the best time to buy oil companies, and which of the following do you think is most interesting, Exxon, Chevron, or Shell?
So the best time is when on CNBC, they're all day talking about the oil price, OPEC, and these kinds of things. If there come again emergency meetings from the OPEC, they are meeting and such, but it's still like under regular circumstances. But you will notice when shit hits the fan with this one. And we got a follow-up question on this also from Andy Stoddard, right? And like, okay, so at what oil price do we think that things get interesting? For me, a psychological barrier would be $50. I've seen in the past that when it starts nearing $50 or under $50, then it's the talk of the day, because in the past, companies were typically profitable around $60 to $70 of oil. That has changed because they are now investing less for the future, maximizing their current reserves. So it's sad to believe that some of the oil companies can be break even around mid 30s or something like that, low 40s. So I think around $50 is where people are anchored about profitability in general for the industry. And that's probably also a time to really start looking at it.
Yeah. I think I don't know about them oil companies, but I know EOG Resources, they can be profitable at 35. Is what is their level. So 35.
Yeah, but when we say profitable, that means they also still need to pay dividends. So the question is how much of this, like if you do, let's say, oil price plus dividends, maybe it becomes like $45 or $50, right, for those companies.
They call it out specifically that their dividend is covered at 35.
So nice.
They call that out specifically. Anything below that, then your dividend is in trouble. But they can cover that dividend at $35, which is quite cool. Jack Jones has asked us our opinions on Taylor Wimpey, ticker symbol TW on the London Stock Exchange.
A really funny name.
Yeah, it's like the Diary of the Wimpy Kid. Honestly, I never heard of them before that. I know they're a UK company, but I didn't know anything about them. They do work in construction, I since learned. So it's quite interesting. I have some friends in that industry over there who would actually know quite a lot about this. So if I was interested in investing, I would definitely get their thoughts on that. But honestly, I don't have too much to say on the company other than I know they're in construction. It's a cyclical business. I already own CRH, which is also in construction. If they're similar to that and well managed, there's probably a place for them. They have a high yield, a high 7% yield as well. I don't know how sustainable that is, but it's probably one to add to the list, just as I could see if it's a competitor in the same space as CRH and see what they're about. But a 7% yield for a construction company seems quite high in my opinion.
Yeah, definitely.
So
yeah, interesting. I mean, there are some good English stocks, right? The dividend growers, even those small and mid caps, they have really a good culture for dividends.
They do, and high yielding companies as well. Do you know what? It's probably an area that we don't explore enough because there's so many, as you said, small to mid cap companies that are not talked about anywhere really. I'm sure that there is some blogs that might touch on them, but we should probably expand their reach a little bit and talk about these a little bit more.
I'm a bit biased there because for me, the UK, well, every time when I look at the UK, I just see finance and old industry.
Yeah, but then you have gems like this that are construction and
Yeah.
So we have
Or
UK
DCC. Yeah.
DCC, Irish company. Um,
Okay, sorry.
we, we won't go there. We won't go there.
By the way, talking about Ireland, I heard that Ireland is having a wealth fund because they are actually having a surplus because of all the tax income from the companies like Apple and such, right? So that's quite interesting. This little island there created like a tax haven.
Yeah,
And because of this, they're building a national health fund, like almost like it sounded like Norway.
yeah. I haven't heard too much about it, but yeah, look, there's no surprise. All these companies are coming here because of the tax, but we're under so much pressure from Europe to expand on this because obviously they're not happy. I mean, France, Germany,
Yeah,
why would they be happy? We're getting
yeah,
the business that we would not get, genuinely would not get if our tax was similar to what the
yeah.
rest of Europe are. So I
But
don't
then
know.
when you walk around, you don't really see it in the streets, right? So
No,
the question is, where is the tax spent? Is the government just hoarding it, or
I mean, you say that we get the tax, but we could go back. I think it was Apple. Was it last year, or the year before? They didn't even pay it. I think they paid a
yeah,
ridiculous. I think I had a company and I paid more tax than Apple did. And it's crazy. Like, so there's always
yeah,
loopholes here, but yeah, it'll be interesting, honestly, to see in 10 years if we still have that same tax
yeah,
bracket, because I mean, Europe for the last 10 years, 20 years are beating on our doors. Come on, guys, come on, get rid of
yeah,
it, get rid of it. And it's probably one good thing that our government has done, because if they do that, we will lose so many jobs. We will lose so
yeah,
many jobs. So
yeah.
let's see. Dividend Diary has asked us about PepsiCo. What do you think about them? The payout ratios. Is their dividend safe?
That's a very interesting question. So let's be point blank. Their free cash flow payout ratio is about 100%. Their EPS payout ratio is a bit below 100%. Is the dividend safe? For me, it's questionable. It's probably borderline safe. Yeah, if you look at how we assess dividend safety, we look at the balance sheet, we look at the earnings power and the cash power, the payout ratio. I mean, generally the balance sheet looks okay, yeah, here, because they're generating enough cash flow, but then everything goes to the dividend.
Yeah,
Yeah, so they don't have any wiggle room. If a black swan event would happen and touching their industry, they might be straight away in serious problem because they don't have any space to make mistakes.
yeah.
Yeah,
It's do you ever find with PepsiCo, it's one of these companies that are overestimated. Like, if we didn't have our dashboard and looking at our
yeah,
dividend safety, and I was to ask you, without looking at numbers, do you
yeah.
feel our dividend is safe? I
I would
guarantee
say
you,
yes.
you would say
Yeah,
yes.
yeah,
100% you would say yes. And I have that feeling with PepsiCo that everyone overestimates them,
yeah.
because of their brand power and what they've done in the past. And
And management execution is
yeah,
excellent as well, right?
yeah, of course. And they're compared to Coca-Cola, and everyone argues that they're
Yeah,
more diversified in Coca-Cola, which they are. But when you look at the numbers and you look at the balance sheet,
yeah.
it
Then
does.
Coca-Cola looks probably better.
The Coca-Cola is better. Yeah, you have to call a
Yeah,
spade a spade. So
yeah,
it's an interesting one for me. I think I said it on the show. One of the earnings, this payout ratio is getting too high for my liking. So it'll be interesting to see how they manage that. Of course, if they grow their free cash flow, if they have a growth spurt there, that all becomes manageable again. But
yeah.
I think Pepsi is one to watch here.
Yeah, definitely. Definitely.
El Cuba has asked us, what are your thoughts on GSK?
I don't like them.
Yeah, we have this question. It pops up every couple of months. They did cut their dividend, I believe. So mm,
Not for me. I mean, I believe they cut their dividend somewhere. When was it? 2022 or something like that. 2021. Yeah, in 2021 they paid 80 pence, and then in 2022 they paid 57.75 pence. Um, Yeah, no, not for me. I don't like them. I don't like how they are managing the company. They cut the dividend. So for me as a dividend growth investor, it's like not even wasting a second of time at them.
yeah.
Not worth my time.
Max A has asked us our opinion on extremely promising dividend stocks, but not on the radar of most investors.
So for me, it's Evolution AB, the Swedish one, which is creating these live casinos, live online casinos. I know it's not under the radar in the niche within the European investment community, like specifically the Nordics. But if you look at the global dividend investment community, I think most people don't know about Evolution.
Yeah.
Very high growth company. I think they pay in general 50% out in dividends. Have been growing the dividends by 20 or 30% per year. The dividend yield is probably still around 2%. So if you talk about under the radar, I think this one is probably under the radar.
I can't think of one, but that's interesting because the question was specifically around dividend stocks, and if you were to mention Evolution AB, you wouldn't be too far wrong saying it's a growth stock. You wouldn't associate with
It's seen as a growth stock.
yes,
Yeah.
yes, you wouldn't associate with a dividend stock. So I think that's a really clever and interesting pick. Yeah, nice one.
Well, hey, this brings us to the end of the show. I hope everyone is still staying with us. It's been a long one, but very interesting questions, very diverse. So thank you, everyone. Well, you know now what we are wishing for when it comes to Christmas, for what we want to see under our Christmas tree. Luckily, I can play a bit of Santa Claus this year, so I think I will get what I want. And yeah, let us also know what you're looking for Christmas, guys. I'm really interested to learn what you have on your wish list, and because I get a lot of inspiration from the community when they're asking questions about tickers and such. And to 9, I say no, but the 10th one inspires me. And, as an example, Evolution AB is one example of that, where I was thinking, okay, I have to look into it, and it was like, whoa, what the hell, yeah.
So that Snap-on is another example. Hey, we have so many examples. We could give so many, but listen, thanks to everyone for your questions. Thanks for tuning in this long if you've stuck with us, and hopefully we'll see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.